This week on Wealth Track, a rock-climbing great investor dedicated to avoiding financial risk. Bond manager Robert Kessler saw the storm clouds of global debt gathering and stayed the course with U.S. Treasuries, while most competitors got caught in the storm. Robert Kessler on why U.S. Treasuries still make sense. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.
Hello and welcome to this New Year's edition of Wealth Track. I'm Consuelo Mack. Before we step into the new, we want to recognize some unexpected developments of the past year. Unexpected by most, but not by this week's great investor guest. What was one of the best investments of the year? Let me give you a few hints. It is shunned by Wall Street, vilified by the vast majority of professional investors, and its yield is near record lows. If you guessed U.S. Treasury securities, you are correct. The much maligned debt of the very indebted U.S. has once again proven to be a sound investment, as it has over the past 5, 10, 20, and even 30-year periods. Well, why have U.S. Treasuries proved so valuable? It is easy to point to the beginning of the great bond bull market in the early 1980s, when yields on 10-year Treasury notes peaked at close to 16% and core inflation reached similar heights. Federal Reserve Chairman Paul Volcker's successful campaign to crush inflation, the key to interest rate levels, pushed the economy into recession back then, giving a huge boost to bond prices. Then there was the recent financial crisis when everyone flocked to the safety of the dollar and liquidity of the Treasury market. But how to explain the most recent Treasury outperformance, which just about everyone missed once again? It came from multiple sources: Federal Reserve policy to keep interest rates low, a global slowdown, and a flight to safety over fears of financial crisis. Once again, the naysayers are exclaiming it can't possibly continue next year. Oh, yes, it can, says this week's guest. He is Robert Kessler, founder and CEO of Denver-based Kessler Investment Advisors, a manager of fixed income portfolios for institutions, governments, and high net worth individuals with a concentration in U.S. government debt. He has been relentless in his conviction that the global economy is going to struggle as the world works its way out of a mountain of debt. And as I have done in every interview I have conducted with him over the past decade, I started out by asking Robert Kessler, why do Treasuries still make sense?
Treasuries, first of all, have made sense for the last 30 years and have outperformed virtually every asset class that we have. But we should put it into context. For the last 20 years or so, inflation has been coming down. And Treasuries are really geared to inflation. That's what moves them up and down. So in the early 1980s, where inflation was 15% and now coming down to 2 or 3, rates on Treasuries had to come down and the price went up. So everyone did very well in Treasuries. That makes some sense. Now we're at a point where inflation is very low, but because we have a world of large amounts of debt, most countries and most individuals, certainly in the United States and certainly in Europe, are now trying to reduce or deleverage all the debt they have. And deleveraging means that rates will come down even further. And so when you say, why Treasuries? Even though the 10-year Treasury is 2%, if I can tell you that the 10-year Treasury will probably go to 1%, that would be a tremendous return with virtually no risk. So Treasuries continue to remain, or at least will remain that way for some years to come as we go through this process of changing the way all of us in Europe and in the United States look at debt and look at conservative investments.
So the working assumption then at Kessler Investment Advisors is that this deleveraging process that we're seeing globally, at least we're seeing it in the developed world, is going to continue, and therefore that inflation rates are going to stay low for several more years to come. So that's your working assumption.
Let's look at the stock market in the United States. I love looking at the stock market
Right.
because the stock market really peaked no more than 4 or 5 years ago. When the Japanese stock market peaked in the late 1980s, it is currently down 60% and still is down 30 years later. This process of credit bubbles, credit deleveraging take a long period of time. This is 4 years for us.
Right. So possibly a generation is what you think we could be talking about.
It probably will be generational.
The argument, as you know, is that treasuries are at historically low yields, and the best 40 years are behind us, and that in fact, if you look at inflation rates in the U.S. and if you look at short-term treasuries, that they are yielding below what the inflation rate is in the United States. Therefore, you are getting a negative yield, and therefore they're not worth holding. You're not getting a return on your money. What's your argument to that?
Well, two things. You said return on your money. What we always want to talk about is return of your money. So let's skip the return for a second. I can make a very strong argument that treasuries are really inversely correlated to all other asset classes, meaning that when things are going bad every place else, you want to own something that's perfect credit and does better than the other things. So,
and is liquid.
And is liquid. And is transparent. And so when we look at a balanced portfolio, when I look at a balanced portfolio, I would always say to someone, so how many treasuries do you have as a percent of your portfolio? Because when the rest of those things go down, emerging markets, S&P index, commodities, they all go down the same way. And they always go down together. So how much of those things, those treasuries, do you own that are going to go up when they go down? And the answer that most people will give you is none.
Right.
What's silly about it is the Chinese don't feel that way, the Japanese don't feel that way, nor do people in the United Kingdom. Most large countries own treasuries, and they own treasuries because of 3 reasons. 1, they're liquid, that's really true. 2, they know where they are all the time. And 3, they're actually making money.
So, this is an interesting point that you made, is that when everyone talks about the Chinese and that foreigners who own treasuries are going to pull out of the treasury market, actually, it's been a great investment for them.
It's been terrific. I had made this point in a discussion you and I were having, that people are always, I won't say people, but some people are always saying things about the Federal Reserve that are not particularly nice. But the fact of the matter is the Federal Reserve has done a terrific job. They've been buying treasuries for the last 2, 3, 4 years, and they're making a fortune.
And they're making money.
They're making a lot of money.
Right.
I don't know why anyone's complaining about the Federal Reserve. It's the only part of the government that's really doing very well. And remember, when the Federal Reserve buys treasuries, they go into reserve. It's not printing money. The reserve simply means it sits there for the banking system because the central bank is the head of the banking system. So when all of this is happening and we sit back and say, what is the best investment over the last 3 or 4 years? It has been treasuries and probably will continue because, as you point out, the cost of money is literally going negative. And that's what the United States is doing. Every major bank in the United States is buying treasuries, and you're not. Every time you hear on television, buy equities today because you have to buy them today, they should be saying, and how many treasuries did you buy?
Let's talk about that, because just about every other investment professional, with few exceptions, has been saying, Robert Kessler, for as long as I've known you, that that U.S. Treasuries are a terrible investment. And especially now they're saying that, that it's because they've done so well, because you're getting negative yields on the short end at any rate, they have no place in your portfolio, that they're absolutely vilified. Why does Wall Street hate treasuries?
First of all, we have to get rid of this concept of negative yields. I wouldn't buy a treasury because the inflation rate is above a treasury. The fact of the matter is, the inflation rate may not be above a treasury. Inflation is coming down in this country, and a lot of economists feel that by next year, you'll be looking at less than 1% inflation.
All right, but it is now. In the short end, short treasuries, they do give you a negative yield. So your purchasing power, as the argument goes, and it's real, is being eroded.
Let me be a little cynical, because
Okay.
I mean, if you're not cynical about this, then it gets a little bit silly. The fact of the matter is, Wall Street is there for one purpose only: to take your money and charge you something. That is the basis to Wall Street. The banking industry, the very large banks that we listen to, they're the ones who got us into the problem 4 years ago, and yet those same people get up on television and they say, buy equities, while they're buying treasuries. So when you ask me, why do they do that?
Right.
Because there is no money in buying treasuries. If I tell you to buy treasuries and you really like them, like anyone who's been doing it, you're going to say, well, thank you very much. I don't think I'll buy anything else. That's not good business for Wall Street. And again, it's not being cynical. It's factual that every portfolio should have a mix of treasuries.
As an investment where I can not only get a return of my money, but a return on my money, how do you think treasuries are going to do?
Treasuries are at 2% and 0 overnight. They're at 0 in Switzerland. They're at 0 in Japan. The ECB just lowered rates down to 1, and they'll probably go down to 0 too. Or Germany is at 0 effectively. The reason these rates are down here is because there's tremendous risk in the market. There's tremendous risk to equities because of the volatility in the market. We see that every day. Someone gets up on television and says, listen, volatility is your friend. Volatility is not your friend. Forget what you hear on television. Volatility is going to take all your money away. That's what it's about. And you have the whole world in this position. We don't know if China is really going to have a hard landing, a soft landing. We don't know if Europe's going to have a serious recession or just a mild recession. And surely in the United States, with the number of people unemployed and the number of people on food stamps and the poverty level, we don't know anything about that either. So treasuries should be at this rate. This is not like, oh, this is special. It tells you, don't take risks. And so again, a return of 2% that's guaranteed, and maybe if Robert Kessler is right, and that 2% goes to 1% on the 10-year, which I believe it will, that's a 9% return. Worst case,
On an annualized basis.
On an annualized basis. Worst case that happens is you got 2%, but you got your money back.
Right.
Over a period of time that's quantifiable.
Let me ask you something else, because a lot of people, say that the longer out you go in maturities, the more risky it is, because you're subject to interest rate moves, much more volatility as your maturities extend. So therefore, when they say, how can you possibly buy a 10-year Treasury at 2%, they're assuming, or a 30-year at whatever it is, they're assuming that you're going to hold it. You're saying, in fact, that that's not the way the real world works, and therefore there's another way to approach it.
There's no one I've ever known who buys IBM and says, I'm holding it for 30 years. Because it's a perpetual call on IBM. I mean, it's perpetual. There's no years that they're guaranteed to give you the money back. No one says you have to hold anything for 10 years. You could sell it tomorrow.
Nor do people.
Nor
the
do people,
point
that's right.
Being, so what's our behavior, and so how, therefore, should we look at longer-term treasuries as an investment?
If you believe the way I believe, that we're in a probably a deflationary world at the moment. When people are deleveraging and selling assets off, this morning we found out that the capital needed in European banks is enormous. That means European banks are going to be selling assets. Selling things means that inflation is not going to happen. So if you don't think inflation is really an issue for the next 5 or 10 years, well, then that treasury is a terrific buy.
Your director of research, Eric Hickman, has done a study on expected returns and looking at past performance, which is what many of our guests will come on, and we'll say, look, they've got a great 10-year track record, 7, 8, 9, 10, 11% annualized returns. And so he said, well, wait a minute, let's look at those returns and what they actually mean, the returns that you can expect if you invest in X fund today.
Yeah, I mean,
so explain the bottom line
if you
of that.
or I got money today, we would listen to someone and they would say, look, why don't you invest it? And I would consider that randomly investing. So if we randomly invest, how does it really look? Because we're told that the S&P index over the last 80 years will produce a 9% annualized return, which is incredible. I mean, it's terrific. So what does it really look like if you just bought it like 29 years ago or 28 years and 6 months.
And that's what Eric did. He took,
we took
every month.
Every single month. I don't care when you invested.
Years.
And we said, what does it look like? How long does it take on the S&P index to get above zero, meaning above the money you put in? We have such a good example. The S&P index today, as of today, at least on this date, it's exactly the same as it was last year. And in fact, if you really look at it for the last 11 years, it hasn't gone anyplace.
Right.
When Warren Buffett says, look, I don't care if I buy IBM at the highest price possible because I'm a long-term holder. It's fine for him to say that. He has $20 billion in his back pocket, and he doesn't care if it takes 11 years. What we wanted to show people was, if you have a retirement fund and you're going to buy equities, and you think because someone says there's a 9% annualized rate of return over the last 80 years,
right,
that you're going to get it. Well, maybe you don't have 11 years to get back to zero or stay at zero, and maybe you don't have 25 years, but you should really think about it. So when you go back to this Treasury question,
right,
that says, okay, I think I'll get 8 or 9%, but worst case is 2%, and I know exactly the amount of time, and I know when it'll pay off, then there's some real reality as to why you want to do that.
We talk to investors that have choices of whether to invest in treasuries or stocks or bonds or a lot of other alternative investments because they're running funds that are like hedge funds. So, they're saying the cheapest asset class on earth right now are major, large cap, global brand name companies. And that if you look at the quality of their balance sheets, if you look at the cash that they are generating, if you look at what the stock is selling for, the company's selling for, versus all of its assets, that basically it's the best than it's just about ever been. Plus, you're getting 3% or better dividends every year, and you're getting a growth stream in dividends, and that it's like they call them corporate tips, and in fact, that they are, that you're going to keep up with inflation, you're going to preserve your purchasing power. And they might be absolutely right about the values of these individual companies that are looking at. What's the flaw in their argument?
It's so seductive what you just said. I mean,
it is.
It just sounds terrific that corporations have more money than they've ever had, blah, blah, blah. The fact of the matter is that is true.
And they're growing. Mm-hmm.
That is true. But it's predicated on someone putting demand into the equation, meaning someone has to buy these things. If you look at the wage side of it, as much as corporations have the most money, consumers now have the least money. And in fact, we have a situation where corporations and consumers are at the same level they were actually in 1929.
In the U.S.?
In the U.S.
Right.
I'm not talking...
Because I'm talking about multinational global companies that are selling to China.
Let's be realistic. The U.S. and Europe are the driving forces, really, in all the underdeveloped countries. Mm-hmm. So if you have this disparity between companies that have huge amounts of net return and people who haven't really deleveraged yet, look at Black Friday and Thanksgiving. People went crazy. It's true, they'll have to pay their credit cards comes January. But the fact of the matter is, wages going down indicate that if the consumer stops buying, then the margins on those companies that you're talking about will be decreased immediately. And suddenly the earnings don't look like the projection for next year. Let me add one more caveat to it. I have never seen a market go down, assuming the stock market could go down for those companies that don't work, or because Europe puts us in a recession, or we're going into one. I have never seen a market go down that those 3 and 5% dividend companies you're naming don't go down the same amount. I don't care if it's
you're talking about the market correlation, this risk-on, risk-off trade, whatever it is, that they're going to get hurt no matter how valuable they look.
A dividend isn't guaranteed by anyone, and the price isn't guaranteed. So if the market goes down 30%, which we should be used to because 3 years ago we saw it, 2 years ago, if it goes down 30%, your stock's going to go down 30%, so who cares about that 3% return I'm getting? And so we get into this craziness of, yeah, but it looks terrific. But maybe it isn't terrific. And so we have to look at the market a little bit when we hear it, and we hear all of this discussion of, hey, they look so terrific. If it looks too good, there's probably something wrong with it. And right now, the indicator, the thing that most people who are in the market fear the most, is that Treasury at 2%. because that Treasury at 2% is telling you the market is not healthy. Otherwise, you wouldn't see Treasuries at 2%.
So you believe that the bond market is really telling us the true story of what is happening with global growth?
It's real money. $1 trillion from China is telling you, I'm not buying stocks. $1 trillion from Japan, I'm not buying stocks. These are people who are forced to be in a marketplace where they know they're going to get their money back. And if you look at all of the world that we're looking at, I don't care if it's emerging markets and I don't care if it's developed markets like Europe, the fact of the matter is rates are very low and getting lowered. Australia, who had higher rates, lowered. Brazil just lowered and announced suddenly their growth pattern doesn't look quite as good. So wait a second, what about all those companies that are making all that money off of Brazil? Maybe that doesn't look as good either. So we have to sit back and say, is it really as good as they're telling us?
So Robert, listening to you, it sounds as if we are in for a long, tough slog and that basically the Treasuries are probably the only place I should be putting my money. Am I missing something? Are you really this bearish about the outlook for the world economy?
I travel all the time. I'm in China a great deal. I think there's tremendous opportunity. At this particular moment, where there's so much uncertainty, it would be smart on anyone's part not to jump too quickly. I talk about Treasuries because it should be a part of everyone's portfolio for all the reasons I just gave. But in terms of being optimistic, of course I'm optimistic. But I don't think people in Italy and Greece and Spain and Portugal are terribly optimistic at the moment with the austerity that's being put on them. And I think in China, where there is an excess amount of capacity, apartments, housing, everything under the sun, pollution, everything that goes with that, I don't think they're so happy either. So I think this is a period of time that you can be optimistic about the future, but it doesn't mean you have to be jumping into markets today. As far as what I would invest in, the history over the last 20 or 30 years is you cannot beat compounding money. The zero coupon Treasuries that are being offered to everyone for your IRA, for your buy regular Treasuries, for your personal account.
Also known as Treasury strips.
Treasury strips have beaten everything hands down. And they beat continually because you're getting the money in advance, the dividends or the yield is reinvested for you. It's almost impossible to beat something that's compounding in that way. That should be where all your money is in a pension account. Don't buy into this silliness that don't worry, over the next 5 years, S&P is going to do terrific because they did lousy over the last 5 years. There is absolutely no logic in that.
So your one investment for a long-term diversified portfolio is something we should all own some of in a portfolio?
If you ask me what I would personally do right now for my personal money, it would be in Treasury strips, it would be in Treasuries, or it could be in cash. If you don't like what I'm saying, there's nothing wrong with cash. The fact that you don't get any return on cash is acceptable. At least you're not losing any money.
And I'm going to ask you to get even more specific. So at what, a 10-year strip?
Buy the longest term Treasury strip you can buy. And the reason is, again, you don't have to sit with it for 30 years, which is the longest you can buy. But if rates move from 3%, where they currently are, to 2%, which I believe they will, the return, if it happens in the next couple of years, which I believe it will, is around 25 to 30%. That is a terrific return. Imagine getting 25, 30% from a Treasury. Worst case scenarios, you're sitting there getting 3%. Not bad. And considering what the alternatives are, probably a terrific investment even now.
Robert Kessler from Kessler Investment Advisors, always a pleasure to have you on Wealth Track. And an independent thinker worth listening to.
Thank you.
As we end 2011, I am instituting what I am calling the Courage of Convictions Award for investors who have stuck to their principles and beliefs despite the unpopularity of their position. The winner is this week's Wealth Track guest, Robert Kessler, who has stood up for his investment of choice, U.S. Treasuries, against withering criticism, as most prognosticators underestimated the growth-suppressing effect of global deleveraging and the appeal of what is still considered to be the safest, most liquid investment on Earth. So this week's action point is don't be afraid to stick with your investment convictions. Frequently, the crowd is wrong. Following the examples of great investors we talked to on Wealth Track, if you have done your homework, assessed the opposing points of view, and feel that the downside risk is limited, do what you think is right for you. Treasuries have not been painful to own, just defending them has been. Independence of thought is a hallmark of all great investors. If you want to see our Wealth Track guests ahead of the crowd, Wealth Track Premium subscribers can now see our program 48 hours in advance, along with other exclusive timely interviews. To sign up, go to our website, wealthtrack.com. I hope you can join us next week. We're going to have our annual interview with Wall Street's long-reigning #1 economist, Ed Hyman, who appears exclusively on Wealth Track, and BlackRock's chief equity strategist, Bob Dahl. We'll talk outlook and investments for 2012. And that concludes this final 2011 edition of Wealth Track. Thank you for watching. Have a wonderful New Year's holiday, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.